Warren Buffett is perhaps the most studied investor in history, yet most people completely misunderstand how he thinks. They see his billions and assume he's lucky, or they focus on his stock picks and miss the mental framework that guides every decision. They try to copy his strategies without understanding the thinking patterns that make those strategies work. For the next hour, we're going inside Warren Buffett's head, not to worship him or blindly copy his investments, but to understand the specific mental models that transformed a middle-class kid from Omaha into one of the world's wealthiest individuals through nothing but patient, disciplined thinking. Born in 1930 during the Great Depression, Buffett's early experiences with economic uncertainty shaped his fundamental approach to money and investing. While other kids were playing games, young Warren was reading financial statements and calculating compound interest. By age 11, he was already buying his first stocks. But here's what's remarkable. The thinking patterns he developed as a teenager are the same ones he uses today to manage hundreds of billions of dollars. Buffett's success isn't just about picking great companies. It's about thinking differently about time, value, and human nature itself. While most investors react to quarterly earnings reports and daily market movements, Buffett operates from a completely different mental framework. He thinks in decades while others think in weeks. He focuses on business fundamentals while others chase stock price movements. He remains calm during market panics while others succumb to fear and greed. This difference in thinking has produced extraordinary results. A single share of Berkshire Hathaway stock purchased for $19 in 1965 would be worth over $500,000 today, a compound annual return of nearly 20% for almost 6 decades. But this performance wasn't achieved through complex trading strategies or insider information. It was achieved through consistent application of simple but profound thinking patterns that anyone can learn and apply. The mental framework we'll explore today goes far beyond investing. These are thinking patterns about patience, discipline, value recognition, and long-term decision-making that can transform any area of your life. Whether you're building a career, starting a business, or making major life decisions, thinking like Warren Buffett will improve your outcomes and reduce your stress. Welcome inside the mind of the Oracle of Omaha. Let's discover how patience becomes the ultimate competitive advantage. Core thinking pattern 1. The circle of competence, knowing what you don't know. Warren Buffett has a concept that shapes every investment decision he makes, yet most people ignore it entirely. The circle of competence. This isn't just about staying within familiar industries. It's a fundamental approach to decision-making that acknowledges the limits of human knowledge and turns those limits into competitive advantages. Buffett defines his circle of competence as the areas where he has sufficient knowledge to make informed judgments about future business performance. Critically, this circle doesn't include every business he finds interesting or every opportunity that seems profitable. It includes only businesses he truly understands, their competitive dynamics, their economics, their management quality, and their long-term prospects. This concept seems obvious, but it's revolutionary in practice. Most investors want to participate in every hot sector and trending opportunity. They chase technology stocks they don't understand, invest in foreign markets they can't analyze, and buy companies and industries they've never studied. Buffett does the opposite. He deliberately restricts his investments to businesses he can comprehend deeply. The circle of competence isn't fixed. It can expand through learning and experience. But Buffett is brutally honest about its current boundaries. When technology stocks were soaring in the late 1990s, investors mocked Buffett for missing the internet boom. His response was simple: "I don't understand these businesses well enough to invest in them." While others lost fortunes when the tech bubble burst, Buffett preserved capital by staying within his circle of competence. Here's the deeper insight. The circle of competence isn't just about what industries you understand. It's about understanding the difference between knowledge and opinion. Most people have opinions about everything. Buffett has deep knowledge about a few things. This distinction is crucial because investment success depends on being right about the future. And being right requires genuine understanding, not just optimistic guessing. The circle of competence also shapes how Buffett evaluates information and advice. He doesn't rely on Wall Street analysts, financial media, or expert predictions about businesses outside his expertise. Instead, he studies companies directly, reading annual reports, understanding their products, analyzing their competitive positions, and evaluating their management teams. This first-hand research allows him to develop genuine insights rather than recycled opinions. Buffett's approach to expanding his circle of competence is methodical and patient. He doesn't jump into new industries because they're hot or profitable. He studies them for years, sometimes decades, before feeling comfortable enough to invest. His eventual investments in companies like Apple weren't sudden pivots. They were the result of gradually developing understanding about how technology businesses create sustainable value. The psychological challenge of maintaining a circle of competence is significant. It requires admitting ignorance about potentially profitable opportunities. It means watching others make money in areas you don't understand while staying disciplined within your areas of expertise. It demands intellectual humility in a culture that rewards confident predictions about everything. But this discipline creates enormous advantages. By focusing only on businesses he understands deeply, Buffett can identify opportunities and risks that escape other investors. He can hold investments through temporary setbacks because he understands the underlying business fundamentals. He can make large bets with confidence because he's operating from genuine knowledge rather than hopeful speculation. The circle of competence also improves decision-making speed and quality. When you deeply understand a business model, competitive dynamics, and management quality, you can evaluate new information quickly and accurately. You don't need to research everything from scratch or rely on external experts for basic judgments. Your accumulated knowledge becomes a decision-making advantage that compounds over time. For individuals, applying the circle of competence concept means honestly assessing your areas of genuine expertise and making important decisions primarily within those areas. This doesn't mean never learning new things or taking calculated risks outside your comfort zone. It means being honest about the difference between knowledge and speculation when stakes are high. In career decisions, this might mean focusing on roles in industries where you have genuine expertise rather than chasing every attractive opportunity. In business ventures, it might mean starting with products or services you deeply understand rather than entering markets you find intriguing but don't truly comprehend. This circle of competence ultimately reflects a mature understanding of how expertise is developed and applied. It acknowledges that depth of knowledge in a few areas is more valuable than superficial knowledge in many areas. It turns the limitations of human understanding from weaknesses into strengths by focusing effort and attention where they can be most effective. Most importantly, the circle of competence prevents the costly mistakes that come from overconfidence and insufficient understanding. By staying within areas of genuine competence, you increase the probability of success while reducing the risk of catastrophic errors. This combination of improved odds and reduced risk is the foundation of all successful long-term strategies. Core thinking pattern 2. Time as an ally, the compound thinking framework. Warren Buffett has called compound interest the eighth wonder of the world, but his understanding of compounding goes far beyond financial returns. Buffett thinks in terms of compound advantages, how small, consistent improvements build into massive long-term benefits across all areas of life and business. Most people understand compounding intellectually but fail to internalize its implications. They know that money invested early grows more than money invested later, but they don't structure their entire decision-making framework around maximizing compound effects. Buffett does. Every major decision is evaluated through the lens of how it will compound over decades. This compound thinking shapes Buffett's approach to time horizons. While most investors operate on quarterly or annual timeframes, Buffett genuinely thinks in decades. His famous quote, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes," isn't hyperbole. It's his actual decision-making criterion. This long-term perspective allows him to ignore short-term volatility and focus on long-term value creation. The compound framework also applies to business quality. Buffett prefers companies with economic moats, sustainable competitive advantages that strengthen over time. A strong brand becomes more valuable with each positive customer experience. A network effect becomes more powerful as more users join. Cost advantages become more pronounced as scale increases. These compounding business characteristics create investment returns that accelerate rather than diminish over time. But compound thinking isn't just about choosing the right investments. It's about minimizing compound damage from bad decisions. Buffett is famous for saying, "The most important thing to do if you find yourself in a hole is to stop digging." This reflects his understanding that losses compound just as powerfully as gains. A 50% loss requires a 100% gain to break even. Multiple small losses can create devastating compound effects that take years to overcome. This awareness of compound damage makes Buffett extremely focused on avoiding permanent loss of capital. He's not trying to maximize gains on every investment. He's trying to avoid losses that would impair his ability to benefit from long-term compounding. This defensive mindset, combined with patience, allows compound effects to work their magic over extended periods. Buffett's compound thinking extends to learning and knowledge accumulation. He spends hours each day reading and studying businesses, not to find immediate trading opportunities, but to build a knowledge base that compounds over time. Each annual report he reads, each business he analyzes, and each management team he evaluates adds to a repository of understanding that informs future decisions. This accumulated knowledge becomes an increasingly valuable competitive advantage. The framework also shapes how Buffett thinks about relationships and reputation. He understands that trust and credibility compound over time through consistent behavior. Each honest dealing, each kept promise, and each transparent communication builds reputation capital that becomes more valuable with age. This long-term approach to relationship building has created a network of business partners, managers, and shareholders who provide opportunities and insights that aren't available to other investors. Compound thinking requires a specific type of patience that most people find psychologically difficult. It means accepting smaller short-term returns in exchange for larger long-term gains. It means watching others apparently get rich quickly while you build wealth slowly. It means staying disciplined when immediate gratification seems more attractive than delayed rewards. But Buffett has structured his entire life around maximizing compound effects. He's lived in the same house since 1958, worked at the same company for over 50 years, and maintained the same core investment philosophy throughout his career. This consistency isn't just personal preference. It's a strategic approach to letting compound effects accumulate without interruption. The compound framework also influences how Buffett thinks about business operations and management. He looks for companies that reinvest earnings at high rates of return, creating compound growth and intrinsic value. He prefers businesses that become more valuable as they grow larger, rather than businesses that face diminishing returns as they scale. These compound characteristics allow strong companies to create increasingly powerful competitive positions over time. For individuals, adopting compound thinking means structuring decisions around long-term accumulation rather than short-term optimization. This might mean choosing career paths that offer learning and skill development over immediate salary maximization. It might mean building relationships based on mutual value creation rather than immediate benefit extraction. It might mean developing habits and systems that improve gradually over time rather than seeking dramatic instant changes. The compound mindset also applies to personal development and skill building. Like Buffett's daily reading habit, small, consistent investments in learning and improvement create knowledge and capability advantages that become increasingly valuable over time. The key is choosing activities and areas of focus that have compounding characteristics, where each increment of progress makes future progress easier and more valuable. Perhaps most importantly, compound thinking provides psychological resilience during difficult periods. When you understand that temporary setbacks don't negate long-term compound effects, you can maintain discipline and perspective during inevitable challenges. This emotional stability becomes its own competitive advantage, allowing you to make rational decisions when others are driven by fear or greed. Compound thinking ultimately reflects a mature understanding of how value is created over time. It recognizes that the most powerful forces in business and life work slowly but inexorably. By aligning decisions with these compound forces rather than fighting against them, you can achieve results that seem disproportionate to your efforts. Time becomes your ally rather than your enemy, and patience becomes your most powerful strategic advantage. Core thinking pattern 3. Mr. Market, understanding emotional versus rational decision making. One of Warren Buffett's most powerful mental models comes from his mentor Benjamin Graham's allegory of Mr. Market, a bipolar business partner who offers to buy or sell shares at wildly different prices depending on his emotional state. This metaphor shapes how Buffett thinks about market volatility, investor psychology, and the relationship between price and value. Mr. Market is sometimes euphoric, offering to pay ridiculous prices for shares in your business. Other times he's depressed, willing to sell his shares for far less than they're worth. The key insight is that Mr. Market's offers tell you nothing about the actual value of your business. They only reflect his current emotional state. Buffett uses this framework to separate market prices from business reality, allowing him to make rational decisions, while others are driven by emotion. Most investors treat market prices as information about value. When stocks go up, they assume companies are becoming more valuable. When stocks go down, they assume companies are worth less. Buffett thinks exactly the opposite. Market prices are information about investor emotions, not business fundamentals. This perspective allows him to buy when others are selling in panic and sell when others are buying in euphoria. The Mr. Market framework requires understanding the psychological drivers of market behavior. Fear and greed create predictable patterns of overreaction that have nothing to do with underlying business performance. When news is good, investors extrapolate positive trends indefinitely, driving prices above intrinsic value. When news is bad, investors assume problems will persist forever, driving prices below intrinsic value. Buffett profits from these emotional swings by maintaining what he calls emotional stability. While Mr. Market oscillates between extreme optimism and extreme pessimism, Buffett remains consistently rational, focused on business fundamentals regardless of market sentiment. This emotional discipline allows him to act as a contrarian, buying when others are fearful and selling when others are greedy. The framework also helps Buffett understand when to ignore market signals entirely. During the 2008 financial crisis, Mr. Market was offering to sell high-quality businesses at Depression-era prices. Most investors interpreted these low prices as signals that the businesses were fundamentally impaired. Buffett saw them as opportunities to acquire excellent companies at discounted valuations because Mr. Market was temporarily irrational. But the Mr. Market metaphor goes deeper than just buying low and selling high. It's about understanding the difference between price and value in all decision-making contexts. Price is what you pay, the immediate cost of any decision. Value is what you get, the long-term benefit of that decision. The market often confuses these concepts, but successful thinking requires keeping them separate. This price versus value distinction applies beyond investing. In career decisions, the price might be current salary or immediate gratification, while the value might be long-term skill development or relationship building. In business decisions, the price might be upfront costs or short-term profits sacrificed, while the value might be market position or customer loyalty gained over time. The Mr. Market framework also provides psychological protection against the social pressure of following crowds. When everyone is buying, it feels natural to buy. When everyone is selling, it feels natural to sell. But Buffett understands that these social pressures represent Mr. Market's emotional contagion, not rational analysis of business prospects. By maintaining analytical distance from crowd behavior, he can make decisions based on fundamentals rather than sentiment. Understanding Mr. Market also requires recognizing your own emotional biases and tendencies. Buffett isn't immune to fear and greed. He simply has systems and frameworks for preventing these emotions from driving his decisions. He evaluates businesses when he's calm and rational, not when he's excited by rising prices or worried by falling prices. This emotional discipline is a learned skill that improves with practice and self-awareness. The framework helps explain why Buffett is comfortable holding cash during expensive markets and investing heavily during market panics. He doesn't feel pressure to participate when Mr. Market is euphoric and valuations are high. He doesn't feel afraid to act when Mr. Market is depressed and opportunities are abundant. This contrarian approach requires confidence in your own analysis and indifference to short-term social approval. Mr. Market thinking also shapes how Buffett communicates with investors and the public. His annual letters to Berkshire Hathaway shareholders consistently focus on business performance rather than stock price performance. He wants shareholders to think like business owners, not traders responding to Mr. Market's daily emotional swings. This long-term perspective creates a shareholder base that supports rational decision-making rather than demanding short-term results. For individuals, applying the Mr. Market framework means developing systems for separating emotional reactions from rational analysis in important decisions. This might involve waiting periods before making major choices, seeking outside perspectives to counter emotional biases, or establishing decision-making criteria in advance of emotionally charged situations. The framework also helps in understanding other people's behavior and motivations. When someone offers something at an unusually high or low price, the Mr. Market model suggests looking for emotional drivers behind the offer. Fear, greed, time pressure, or social dynamics might be creating opportunities or risks that aren't immediately apparent. Most importantly, the Mr. Market metaphor teaches that emotional volatility in others can become competitive advantage for those who remain rational, while others are driven by changing moods and social pressures. Disciplined thinking based on fundamental analysis creates opportunities for superior outcomes. The key is developing the emotional stability and analytical frameworks to profit from others' irrationality rather than being infected by it. Core thinking pattern 4. The margin of safety, building cushions into every decision. Warren Buffett's investment approach is built on a foundation concept inherited from Benjamin Graham, the margin of safety. But Buffett has expanded this idea far beyond simple value investing into a comprehensive framework for making any decision under uncertainty. Understanding how he thinks about margins of safety reveals a systematic approach to risk management that can be applied to every area of life. The basic margin of safety concept in investing is straightforward. Only buy stocks when the market price is significantly below your estimate of intrinsic value. If you calculate a company is worth $100 per share, you might only buy at $70 per share, creating a 30% margin of safety. This cushion protects against estimation errors, unexpected problems, or temporary market volatility. But Buffett's thinking about margins of safety goes much deeper than this simple formula. He understands that the future is inherently uncertain, and even the best analysis can be wrong. Rather than trying to predict the future perfectly, he structures decisions to be profitable even if his predictions are somewhat incorrect. This defensive mindset shapes every aspect of his investment process. Buffett builds multiple layers of margin of safety into his investments. First, he only invests in businesses he understands deeply, reducing the chance of fundamental misunderstanding about the business model or competitive dynamics. Second, he looks for companies with strong competitive advantages that protect against unexpected challenges. Third, he requires significant discounts to intrinsic value before purchasing. These layered protections mean that several things would have to go wrong simultaneously for an investment to result in permanent loss. The margin of safety concept also influences how Buffett thinks about business quality. He prefers companies with predictable earnings, strong balance sheets, and conservative management teams because these characteristics provide natural margins of safety against economic downturns or industry disruptions. A company with no debt can survive revenue declines that would bankrupt a highly leveraged competitor. A business with recurring revenue streams is less vulnerable to economic cycles than one dependent on sporadic large transactions. Buffett extends margin of safety thinking to portfolio construction and capital allocation. Rather than investing everything in his best idea, he diversifies across multiple high-quality investments. Rather than borrowing money to increase returns, he maintains significant cash reserves. Rather than optimizing for maximum possible gains, he structures the portfolio to minimize the probability of large losses. This conservative approach ensures that temporary setbacks don't impair long-term wealth building. The framework also applies to how Buffett evaluates management teams and corporate governance. He looks for managers with strong track records, conservative accounting practices, and shareholder-friendly capital allocation policies. These management characteristics provide margins of safety against poor decision-making, accounting fraud, or value-destroying activities. By investing only with managers he trusts, Buffett reduces the risk of permanent capital impairment due to management mistakes. But margin of safety thinking extends beyond investing into general decision-making frameworks. Buffett applies similar logic to business operations, career choices, and personal relationships. The key is identifying the primary risks in any situation and building cushions against those risks materializing. In business decisions, this might mean maintaining higher cash reserves than immediately necessary, diversifying customer bases to avoid dependence on single relationships, or building operational capabilities beyond current needs. These margins of safety cost money in the short term, but provide resilience against unexpected challenges that could threaten business survival. In career planning, margin of safety thinking might involve developing multiple valuable skills rather than specializing in one narrow area, maintaining emergency funds to provide flexibility during career transitions, or building professional networks that extend beyond current job requirements. These investments in optionality and resilience provide protection against industry changes, economic downturns, or personal circumstances that could disrupt career progression. The psychological aspect of margin of safety thinking is crucial. Building cushions into decisions provides confidence and emotional stability during uncertain periods. When you know you can survive several things going wrong, you can make bolder decisions and maintain discipline during temporary setbacks. This emotional resilience becomes its own competitive advantage in environments where others are paralyzed by uncertainty. Margin of safety thinking also influences how Buffett approaches learning and knowledge development. Rather than relying on single sources of information or narrow expertise, he constantly expands his knowledge base across multiple disciplines and perspectives. This intellectual diversification provides margins of safety against being wrong about important trends or missing critical insights. The framework requires balancing safety with opportunity. Too much margin of safety can lead to excessive conservatism and missed opportunities. Too little margin of safety can lead to catastrophic losses. Buffett has developed intuition for finding the optimal balance, enough safety to sleep well, but not so much safety that growth becomes impossible. For individuals, applying margin of safety thinking means identifying the key risks in your goals and building systematic protections against those risks. This might involve financial planning that assumes lower returns and higher expenses than optimistic projections suggest. It might mean career planning that prepares for industry disruption or economic downturns. It might mean relationship building that doesn't depend entirely on single key connections. The margin of safety ultimately reflects a mature understanding of uncertainty and risk management. Rather than trying to predict and control an inherently unpredictable future, it focuses on building resilience and adaptability to handle whatever future actually emerges. This approach sacrifices some upside potential in exchange for dramatically reduced downside risk, creating sustainable competitive advantages that compound over time. Most importantly, margin of safety thinking provides the psychological foundation for long-term success. When you know you're protected against reasonable worst-case scenarios, you can focus on value creation rather than constantly worrying about survival. This mental clarity and emotional stability enables better decision-making and more consistent execution of long-term strategies. Core Thinking Pattern 5. Quality over quantity. The art of selectivity. Warren Buffett's approach to investment selection reflects a profound understanding of how attention, energy, and resources should be allocated for maximum effectiveness. Rather than diversifying across hundreds of investments, he concentrates on a relatively small number of exceptional opportunities. This quality over quantity philosophy shapes every aspect of his decision-making process and provides insights applicable far beyond investing. Most professional investors try to minimize risk through diversification, owning many different investments to reduce the impact of any single failure. Buffett takes the opposite approach. He minimizes risk through concentration on his best ideas. His reasoning is that risk comes from not knowing what you're doing, not from putting your eggs in one basket. If you truly understand a few businesses deeply, concentrating your investments in those businesses reduces rather than increases risk. This concentration strategy requires exceptional selectivity. Buffett evaluates hundreds of potential investments for every one he actually makes. This high rejection rate isn't inefficiency. It's the key to his success. By being extremely selective, he can focus his limited time and attention on truly understanding the businesses he owns rather than spreading his analysis thin across many mediocre opportunities. The quality over quantity framework extends to how Buffett thinks about business characteristics. He looks for companies with moats, sustainable competitive advantages that protect against competition and allow for predictable long-term profitability. These might include strong brands, network effects, cost advantages, or regulatory protections. Rather than investing in average businesses at great prices, he prefers great businesses at fair prices. This evolution in thinking represents a major shift from his early career, when he focused more heavily on statistical bargains, companies trading below book value regardless of business quality. Under the influence of Charlie Munger, Buffett learned that paying slightly more for exceptional businesses produces better long-term results than paying very little for mediocre businesses. This insight reflects sophisticated understanding of how quality compounds over time. Quality thinking also shapes Buffett's approach to management evaluation. Rather than trying to fix poor management teams or improve struggling businesses, he looks for companies with outstanding managers already in place. This selectivity allows him to benefit from others' expertise rather than spending his time solving management problems. By partnering only with proven executives, he can focus on capital allocation rather than operational management. The framework influences portfolio construction in ways that seem counterintuitive to traditional finance theory. Rather than diversifying across many asset classes and investment styles, Buffett concentrates on what he calls wonderful businesses purchased at sensible prices. This concentration exposes him to more short-term volatility, but provides better long-term returns because exceptional businesses compound wealth more effectively than diversified portfolios of average investments. Quality over quantity thinking requires saying no to most opportunities, even good ones. Buffett has passed on countless profitable investments because they didn't meet his standards for exceptional quality. This discipline is psychologically difficult because it means watching others make money on investments you rejected. But Buffett understands that opportunity costs work both ways. Every mediocre investment prevents investment in something truly exceptional. The selectivity framework also applies to how Buffett uses his time and attention. Rather than attending numerous meetings, conferences, and social events, he protects his schedule for activities that provide the highest value: reading, thinking, and analyzing potential investments. This time management reflects the same quality over quantity thinking that guides his investment selection. Buffett's communication style reflects similar principles. Rather than frequent press interviews or public appearances, he focuses on high-quality, substantive communication through his annual letters to shareholders and the annual Berkshire Hathaway meeting. These concentrated communication events provide more value to stakeholders than scattered interactions that would dilute the quality of his message. For individuals, applying quality over quantity thinking means becoming more selective about career opportunities, relationships, and personal commitments. Rather than trying to network with everyone or pursue every interesting opportunity, focus on building deep relationships with exceptional people and pursuing opportunities that align with your strengths and values. In career development, this might mean specializing deeply in areas where you can become truly excellent rather than developing shallow competence in many areas. It might mean working for fewer, higher quality companies rather than maximizing the number of positions on your resume. It might mean focusing on building expertise that becomes more valuable over time rather than chasing every new trend or skill requirement. The framework also applies to learning and personal development. Rather than trying to read everything or learn about every topic, focus on developing deep understanding in areas that complement your strengths and support your long-term goals. Quality learning that changes how you think is more valuable than quantity learning that only provides information. Quality over quantity thinking requires developing high standards and the discipline to maintain them despite social pressure or short-term opportunities. This means being comfortable with having fewer options if those options are genuinely superior. It means being willing to wait for exceptional opportunities rather than settling for good enough. The ultimate benefit of quality thinking is that exceptional choices compound more effectively than average choices. One great relationship provides more value than many superficial connections. One outstanding career opportunity provides more long-term benefit than multiple mediocre positions. One exceptional investment provides better returns than diversified portfolios of average investments. Most importantly, quality over quantity thinking reduces complexity and increases focus. By concentrating on fewer, better choices, you can apply more attention and energy to making those choices successful. This focused approach creates better outcomes and reduces the stress that comes from managing too many competing priorities and relationships. Core thinking pattern 6. Contrarian comfort, being right while being lonely. Warren Buffett has built his fortune by being comfortable with positions that seem wrong to almost everyone else. This contrarian thinking isn't just about buying when others sell. It's about developing the psychological strength to trust your own analysis when it contradicts popular opinion. Understanding how Buffett thinks about contrarian positions reveals sophisticated frameworks for independent decision-making that apply far beyond investing. The foundation of contrarian thinking is understanding that markets are driven by human psychology, and human psychology creates predictable patterns of overreaction. When news is positive, people extrapolate good trends indefinitely, creating overvaluation. When news is negative, people assume problems will persist forever, creating undervaluation. These emotional swings create opportunities for investors who can think independently of crowd sentiment. But successful contrarian investing requires more than just betting against popular opinion. Buffett doesn't buy simply because others are selling. He buys when his independent analysis suggests that selling is irrational. This distinction is crucial because being contrarian for its own sake is just as dangerous as following the crowd. The key is having conviction based on superior analysis, not just different opinions. Buffett's contrarian approach is most visible during market panics when fear dominates rational thinking. During the 2008 financial crisis, when most investors were selling everything, Buffett was investing billions in companies like Goldman Sachs and General Electric. He wasn't gambling. He was applying his analysis of long-term business value, while others were reacting emotionally to short-term uncertainty. The psychological challenges of contrarian thinking are enormous. When you're buying while everyone else is selling, you face constant questioning of your judgment from friends, family, media, and professional peers. This social pressure can undermine confidence even when your analysis is correct. Buffett has developed mental frameworks for maintaining conviction despite external skepticism. One key framework is separating temporary business problems from permanent business impairment. During crises, markets often treat temporary challenges as permanent threats, creating opportunities for investors who can distinguish between the two. Buffett looks for high-quality businesses facing temporary difficulties that will likely recover when circumstances improve. Another framework involves understanding the difference between volatility and risk. Most people become more worried as stock prices decline, interpreting falling prices as increasing risk. Buffett thinks the opposite. Falling prices of good businesses represent decreasing risk and increasing opportunity. This perspective requires genuine conviction about business fundamentals independent of market prices. Contrarian thinking also requires what Buffett calls emotional stability during periods when your positions look wrong. Even with correct long-term analysis, contrarian investments often get worse before they get better. Markets can remain irrational longer than seems possible, and social pressure to abandon contrarian positions intensifies as losses mount. Buffett manages this psychological pressure through several techniques. First, he sizes positions appropriately, so that even if he's wrong, the losses won't impair his long-term strategy. Second, he maintains conviction by regularly reviewing his original analysis and updating it based on new information rather than price movements. Third, He focuses on business performance rather than stock performance as validation of his decisions. The contrarian framework extends beyond crisis investing to everyday decision-making. Buffett regularly takes positions that seem conservative or old-fashioned compared to prevailing business trends. While others chase growth stocks, he focuses on profitable businesses. While others embrace complex financial instruments, he sticks to simple, understandable investments. This conservative contrarianism has protected him from numerous bubbles and fads. Successful contrarian thinking requires developing information sources and analytical frameworks independent of popular opinion. Buffett spends enormous time reading primary sources, company reports, industry publications, and historical data, rather than relying on Wall Street research or financial media. This independent research allows him to form opinions based on facts rather than interpretations of facts. The contrarian mindset also shapes how Buffett thinks about timing and patience. While others feel pressure to act quickly when opportunities appear, Buffett is comfortable waiting for prices to reach his target levels. While others feel pressure to sell when investments aren't immediately profitable, Buffett is comfortable holding through temporary setbacks. This patience is essential for contrarian success because markets often take years to recognize value. For individuals, developing contrarian comfort means building confidence in your own analysis and judgment while remaining open to new information that might change your conclusions. This requires developing expertise in areas important to your decisions, so you can evaluate situations independently rather than relying entirely on others' opinions. In career decisions, contrarian thinking might mean pursuing opportunities that others consider risky or unfashionable if your analysis suggests they offer superior long-term prospects. In business decisions, it might mean maintaining strategies that produce consistent results even when competitors are pursuing apparently more exciting approaches. The key is distinguishing between contrarian positions based on superior analysis versus contrarian positions based on stubbornness or ego. Good contrarian thinking involves constantly testing your assumptions against new evidence and changing your mind when facts change. Bad contrarian thinking involves maintaining positions despite overwhelming evidence that you're wrong. Contrarian comfort ultimately provides competitive advantages in any field where popular opinion influences prices or opportunities. When others are driven by emotion, fear, or social pressure, independent thinking creates opportunities for superior results. The challenge is developing the psychological strength to maintain conviction while remaining intellectually honest about when you might be wrong. Most importantly, contrarian thinking provides protection against the costly mistakes that come from following crowds. By developing independent judgment and the courage to act on that judgment, you can avoid the bubbles, fads, and panics that destroy wealth and create regret. This independence becomes increasingly valuable in a world where social media and instant communication amplify crowd behavior and emotional contagion. Daily mental habits, the Warren Buffett routine. Understanding Warren Buffett's daily mental habits provides the practical foundation for applying his thinking patterns consistently. His extraordinary success isn't just the result of brilliant insights. It's the product of systematic daily practices that compound over decades into exceptional judgment and decision-making capability. These habits can be adapted and applied regardless of your profession or circumstances. The cornerstone of Buffett's daily routine is dedicated reading and learning time. He estimates spending 80% of his day reading newspapers, annual reports, industry publications, biographies, and books on subjects ranging from business to history to science. This isn't casual reading for entertainment. It's systematic knowledge accumulation designed to improve his understanding of businesses, industries, and human nature. Buffett's reading approach is methodical and purposeful. He starts each morning with multiple newspapers to understand current events and their potential business implications. He then reviews reports from companies in his investment portfolio and potential investment targets. Finally, he reads books and longer-form content that provide historical perspective and deeper insights into business principles and human behavior. The key insight about Buffett's reading habit is that he's building what Charlie Munger calls mental models, frameworks for understanding how the world works. Each book, report, An article contributes to a comprehensive understanding of business patterns, economic cycles, and investor psychology. This accumulated knowledge becomes the foundation for rapid, accurate decision-making when opportunities arise. Buffett also maintains what he calls thinking time, periods dedicated to reflection, analysis, and strategic consideration without immediate pressure to make decisions. Unlike most executives who fill their schedules with meetings and operational tasks, Buffett deliberately protects time for contemplation. This thinking time allows him to process information, consider long-term implications, and develop insights that wouldn't emerge from reactive, rushed decision-making. His physical environment supports this contemplative approach. Buffett's office is simple and distraction-free, without the multiple screens, constant notifications, and interruptions that characterize most executive environments. This simplicity allows for focused attention on whatever he's reading or considering at the moment. Buffett's meeting and communication habits reflect similar priorities. He limits meetings to those that are truly necessary and insists on thorough preparation and clear agendas. When he does meet with people, he focuses on listening and learning rather than talking and convincing. This approach allows him to gather information and perspectives that inform his decision-making without wasting time on unproductive interactions. The habit of writing annual letters to Berkshire Hathaway shareholders serves multiple purposes beyond communication. The writing process forces Buffett to clarify his thinking, review his decisions, and articulate his reasoning. This annual reflection helps him identify patterns in his decision-making, acknowledge mistakes, and reinforce the principles that guide his strategy. Buffett's approach to information consumption is highly selective. Rather than trying to stay current with every business development or market trend, he focuses on information that's genuinely useful for his decision-making. He ignores most financial media, Wall Street research, and expert predictions, preferring to form his own opinions based on primary sources and fundamental analysis. This selective attention extends to his professional relationships and social activities. Buffett maintains a relatively small circle of trusted advisors and friends rather than trying to network broadly. He focuses on deep, long-term relationships that provide genuine value rather than superficial connections that consume time without providing insight. The habit of maintaining detailed records and reviewing past decisions is crucial for continuous improvement. Buffett regularly reviews his investment decisions, analyzing what went right, what went wrong, and what lessons can be applied to future decisions. This systematic learning from experience prevents repetition of mistakes and reinforces successful patterns. Buffett's approach to technology and communication reflects his focus on what's essential versus what's merely available. While he's adopted some modern communication tools, he avoids the constant connectivity and information overload that can impair deep thinking. He uses technology to support his core activities, reading, analyzing, and communicating, rather than letting technology drive his schedule and attention. Physical health habits support mental performance. Buffett maintains regular exercise routines, adequate sleep, and relatively consistent daily schedules. While he's famous for enjoying Coca-Cola and hamburgers, he understands that physical health influences mental clarity and decision-making quality over the long term. Perhaps most importantly, Buffett has developed what might be called psychological habits that support rational decision-making. He regularly examines his own biases and emotional reactions, especially during periods of market volatility. He has systems for preventing fear and greed from influencing his judgment, such as making decisions based on predetermined criteria rather than emotional reactions to current events. For individuals seeking to apply similar approaches, the key insights are about priority and focus. Rather than trying to do everything, identify the activities that provide the highest long-term value for your goals and circumstances. Protect time for these activities even when they don't seem immediately urgent or productive. Develop systematic approaches to learning and information consumption. Rather than passively consuming whatever information comes your way, actively seek information that builds your understanding of areas crucial to your success. Focus on primary sources rather than second-hand interpretations whenever possible. Create environments and routines that support focused thinking and decision-making. This might mean reducing distractions, limiting meetings, or establishing regular periods for reflection and strategic thinking. The goal is creating conditions where your best thinking can emerge consistently rather than hoping for occasional moments of insight. Most importantly, develop habits of self-reflection and continuous improvement. Regularly review your decisions and their outcomes, looking for patterns that can inform future choices. This systematic learning from experience, combined with continuous knowledge acquisition, creates compound improvements in judgment and decision-making that become increasingly valuable over time. The daily mental habits that support exceptional thinking aren't complicated or mysterious. They're simple practices applied consistently over long periods. The challenge is maintaining these habits despite social pressure to be constantly busy and immediately responsive. But for those who can develop and maintain such habits, the compound benefits in decision-making quality and life outcomes are extraordinary. Conclusion: building your patient value investor mind. We've spent this hour exploring the mental frameworks that transformed Warren Buffett from a middle-class kid in Omaha into one of history's most successful investors. But these aren't just investment strategies. They're thinking patterns that can transform any area of your life where patience, value recognition, and long-term decision-making matter. The circle of competence teaches us to focus our efforts where our knowledge is deepest rather than spreading ourselves thin across every attractive opportunity. This doesn't mean limiting your curiosity or avoiding new learning. It means being honest about the difference between knowledge and opinion when stakes are high. Apply this framework to career decisions, business opportunities, and major life choices. Compound thinking reveals how small, consistent actions create extraordinary long-term results. Whether you're building wealth, developing skills, or cultivating relationships, the magic happens when you structure decisions around what will compound over decades rather than what feels good today. Time becomes your ally when you align your actions with its natural power. The Mr. Market framework provides psychological protection against the emotional contagion that destroys decision-making. In any situation where fear and greed influence others' behavior, maintaining rational analysis based on fundamentals creates competitive advantages. Learn to see price and value as separate concepts, and profit from others' inability to make this distinction. Margin of safety thinking protects against the uncertainty inherent in all important decisions. Rather than trying to predict the future perfectly, build cushions that allow you to prosper even if your predictions are wrong. This defensive mindset, combined with patience, creates sustainable advantages that compound over time. Quality over quantity principles teach us that exceptional choices compound more effectively than average choices. Be ruthlessly selective about opportunities, relationships, and commitments. It's better to have fewer, deeper involvements that align with your values than many superficial engagements that dilute your attention and energy. Contrarian comfort allows you to trust your own analysis when it contradicts popular opinion. This isn't about being different for its own sake. It's about having the intellectual courage to act on superior analysis despite social pressure to conform. Independent thinking becomes increasingly valuable in a world where crowd behavior is amplified by instant communication. The daily mental habits we explored, dedicated reading, systematic thinking, selective attention, and continuous learning provide the practical foundation for applying these frameworks consistently. Excellence in thinking, like excellence in anything else, results from superior daily practices applied over extended periods. But remember that thinking patterns alone don't create results. They must be combined with action, persistence, and the humility to learn from both successes and failures. Buffett's success came not just from thinking differently, but from acting on that thinking consistently over 7 decades. Start implementing these frameworks gradually rather than trying to adopt everything at once. Choose one pattern that resonates most strongly with your current challenges and practice applying it systematically. As it becomes habitual, add other frameworks until you've developed a comprehensive approach to patient, value-focused decision-making. The principles you've learned today are timeless because they're based on fundamental aspects of human nature, market psychology, and value creation that don't change with technology or social trends. They worked in Buffett's early career and continue working today because they align with enduring realities about how wealth is created and preserved over time. Your journey inside Warren Buffett's head is complete, but your journey applying these insights is just beginning. The frameworks are proven, the principles are transferable, and the potential is unlimited. The question isn't whether patient value thinking works. Buffett has proven it does. The question is whether you'll have the discipline and persistence to make it work for you. Patience is your greatest competitive advantage in an impatient world. Value recognition is your edge in markets driven by emotion. Long-term thinking is your path to compound success. The tools are in your hands. The principles are clear. The path is mapped. Now it's time to think like Buffett and build like Buffett. Your success story starts with your next patient, value-focused decision.